So if we're summing things up, the Quebec market, we're very busy right now. Experienced buyers are there. We've been talking about it for a while, but now they're present, asking a lot of questions, but we're putting in place a lot of creative real estate transactions. And I could tell you that prices have not really moved yet and that are still very high compared to the rest of Canada. Hi, this is Thierry Samlal from PMML. Today I want to present to you market statistics for the province of Quebec in multifamily for the month of July 2023. A very hectic summer. We're extremely busy right now with a busy market with a lot of questions, meaning that a lot of buyers want to know where the market's going. A lot of sellers want to reposition their portfolios and maybe sell some assets to become partially liquid. And that creates enormous amounts of possibilities on the market right now. So the buyers, of course, are concerned with the hike of interest rates. And due to the fact that the real estate transactions in multifamily right now are extremely long, most of the buyers are financing through the CHMC programs, including the MLI Select program based on affordability or energy efficiency cost reductions. Those two programs are really full right now, and the CHMC has trouble to be able to produce files on time. We're talking about lead times right now with financing of about 8 months, which is huge in the market where the interest rate parameters are changing extremely fast and that we're not sure where we're going with the economy. So buyers have a lot of questions. Promise to purchases are becoming more and more creative with different caps and different conditions that we were not seeing before, but they're being done. So the buyers that are on the market right now are really experienced buyers. They've been on the market in the past. They already have a good quantity of multifamily assets or real estate assets of other categories that are coming into the multifamily business. A lot of family offices are out there right now looking to buy, and a lot of private investors that solely own an incredible amount of multifamily units in Montreal and the province of Quebec are transacting right now. So we're seeing transactional volumes that are resembling a lot what we were seeing pre-COVID. COVID, of course, increased transactional volumes really importantly in the province of Quebec, where we have a large quantity of tenants. As you know, Quebec is a tenant-based homeowners are seldom compared to the rest of Canada in the province of Quebec. So a lot of tenants. Also, the market has been pushed forward greatly this summer by the fact that we've had an incredible increase in rents that was permitted by the Tribunal Administratif du Logement this year. Increases that were approximately between 2.8 to 7% when you're looking at what the TAL has put forward. But in reality, if I'm talking to different owners right now, we're looking at increases that are around 10%, which is great. If you're compiling that 10% increase on what we had last year, that makes it an incredible value add in only 2 years in the province of Quebec. Of course, expenses have gone up as elsewhere, but that historic high of increase is definitely pushing the market forward. I even have some owners that have changed the tenants that are in place, either because tenants are leaving or they've offered them other units in the buildings that they already have. And they were able to increase, in average, their rents of 15% this year. Now, for the sellers that are repositioning their portfolios, what they want to do right now is keep the value adds and get rid of some already partially optimized buildings, very well located, either because they don't need them in their portfolio anymore, or either because they want to become partially liquid, not totally liquid, but partially liquid, to see what's going to happen on the coming market, to see if any opportunities are going to pop up that they're going to be able to jump on. This stress is not yet, we cannot feel the stress yet in the market. We'll see what's going to happen in fall. But for the moment, we're talking about a lot of volume, a lot of activity, It's hard to see where we're going with the price per doors in the next few months because a lot of the transactions are now in the pipeline, and those transactions are going to take between 6 to 9 months to close. Let's go see what's happening with cap rates right now. Really interesting to compare ourselves what we had, say, August 2022. When we're looking at the larger scale assets on the island of Montreal, the average price per door for buildings below 50 units was $192,000 per door at a cap rate of 3.63. When we're continuing in that category of assets, the lower than 50 doors, but larger scale assets, say 30 to 40 doors, we are now at $198,000 per door, almost 1 year later, at a cap rate of 4.19. So that means that the average price per door rose $6,000 per door, going from $192,000 per door to $198,000 per door. But the cap rates have risen, and we're going from 3.63 to now 4.19%. What does that mean? That means that the buildings that are being sold right now on the market are buildings that already have partial value add already factored into the pricing, meaning that the sellers have already optimized certain rents and optimized and done expenses and renovated certain units, and now are putting those units back onto the market, and buyers are buying them, looking at the opportunity of scaling even forward over time. But partial part of that value add has already been absorbed by the seller. If we're going in buildings of categories of 50 doors and above, if we were in August 2022, the average price per door was $226,000 per door at a cap rate of 3.83. Today, we're still at $226,000 per door, but now at a cap rate of 3.02. Between that time, in the past year, we did go up to prices of $239,000, $236,000, $243,000 in average per door, but at cap rates are about 3.9 to 3.97. Now we're down to 3.02. What does that mean? That means that at the end of 2022, a lot of optimized assets of larger scale, 50 doors and above, concrete, with a lot of value add already factored into the pricing, meaning taken out by the previous sellers, have been sold on the market. Now what we're seeing is buildings, same price per door, $226,000 per door, going for a cap rate of 3.02, meaning that the net operating income on the building is lower than what we were seeing before, and people are still willing to pay higher prices. So it's a question of offer and demand. What we're seeing in the market right now for 50 doors and above are definitely buildings that could be scaled up on value add, which is a great opportunity for investors that are purchasing these assets. Let's go see our top 5 transactions. A major transaction that took place in Longueuil, the Carrefour des Arabes was sold, a huge apartment complex comprised of different building sizes, mostly 8 units combined side by side, combining into 16 units. In that portfolio, Carrefour des Arabes, that was already owned by a REIT in the past, sold to a private investor, private investment fund in Longueuil on the south shore of Montreal, then resold to a major building owner in downtown Quebec, that purchased this portfolio, did some renovations, repositioned it, ready for the MLI Select program, and resold it to a private investor based in Longueuil that already has other buildings in the immediate area and that wanted to purchase these buildings without necessarily injecting a lot of money into renovations, but bought the asset knowing that there's still value add to put into it. And this major transaction, if I'm looking at the larger buildings that were sold, so there's a few buildings of 40, 45 units, they sold between $139,000 to $162,000 per door at cap rates ranging between 4.1 and 4.6, which is really interesting, knowing that at the time that this deal closed, that probably the interest rates were locked in around probably 4.1, 4.2, which can give on the total portfolio almost a low level of return, but a lot of value add over time to go and squeeze out the asset, and also the owner owning different buildings in that area was able to, of course, control the rents and to simply add extra buildings for easier management. Let's go to Ville-Saint-Laurent. Ville-Saint-Laurent, a lot of concrete buildings were sold in the past months. I've been telling you a lot about this area, which is located north of Montreal, midway, say, between Laval and Montreal. A lot of concrete assets, close to Highway 15, close to Henri Bourassa, close to a train station and all the services. A multi-ethnic local clientele willing to pay the high dollar to be in that area. And these concrete assets are going one by one and slowly over time. What's interesting with this one is there's a lot of residual land on site. The building is only 6.5 stories high, concrete, and the other buildings in the area are much higher. So there's maybe a possibility over time of repositioning the asset, maybe adding some apartments and becoming even more attractive for the market. This asset is on the Gear Street, construction 1966, and went for $179,000 per door for 185 units. A transaction of $33 million from a private investor to another private investor. So we're seeing a lot of these private investors on the market that are not pulling out equity of their portfolios, repositioning their assets, selling out some assets and going back liquid to buy these concrete buildings. We're seeing the sellers that are selling these concrete buildings going towards new multifamily builds, purpose-built assets sometimes, and going towards a new market. So there's a segmentation of the market right now, but we're seeing investors traveling and growing through different categories of assets as they go along, which shows the resiliency of the Montreal market right now in the multifamily compared to other markets in Canada. A transaction on Henri Bourassa in the Huntsic. For those who know Huntsic, that's north of Montreal, north end of Montreal, close to Laval. This transaction for a 38-door asset went for $153,000 per door. And now I want to do some comparing with you. So this asset went for a low price. So we could see that there's owners willing to sell properties at lower prices right now, but it's not the general market. If we're looking at another transaction that I want to present to you in Ville-Saint-Laurent, which is very close to Huntsic, for a similar asset, walk-up asset, 3 stories above ground, your typical building type for 36 units, that went for $183,000 per door, and that was not in a better condition. So we're talking about a $30,000 difference here per door, which is extreme for assets which are in basically the same condition. So my opinion is probably that the property in Huntsic and Henri Bourassa sold for too cheap, and the other property went for markets, considering that it sold for $183,000 per door, but at a cap rate of 3.2, meaning that the buyer thinks that strong renovations and value add would bring this property back to par to market for that category, which is about at a cap rate of 4.1, but is still willing to pay $183,000 per door, meaning that over time, after renovations, probably that the overall cost for the asset is going to be $220,000 per door, $210,000 per door. So that would give you an idea of where the Saint Laurent market is going to go over time. Finally, I want to talk to you about a transaction that took place in Gatineau. Gatineau, we've been talking about land for a long period of time. Land in Gatineau is probably the place where you're going to pay the most, where buyers are willing to pay the most for land in the province of Quebec, except for the downtown Montreal core, of course. Usually transactions go for between $45,000 to $47,000 per door in Gatineau these days. And this asset that just sold, which was basically purpose-built for one of my colleagues that works in real estate that I know very well, that went for $326,000 per door, which is pretty linear if you're comparing other values that of price per door assets that were sold about a year ago in that same territory. So what I want to tell you about Gatineau is it's not a area to under consider, because there's a lot of densification taking place in Gatineau right now. It's just that the contractors are not able to sell their assets at a correct price per door because of construction costs, which are too high, and the rents that are not necessarily meeting the construction costs. So what you're going to see in that area is a lot of purpose-built assets, 4 stories, say, in total, walk-up that are going to be sold in the next 2 years, and then hyper-densification that are going to take place, say, starting 2025 and after. So if we're summing things up, the Quebec market, we're very busy right now. Experienced buyers are there. We've been talking about it for a while, but now they're present, asking a lot of questions, but we're putting in place a lot of creative real estate transactions. And I could tell you that prices have not really moved yet, and that are still very high compared to the rest of Canada, but with a lot of value add. Immigration is high. The students are back in town. As you know, Montreal has a lot of university, a lot of students come in here. A lot of temporary immigrants are here also, taking up a lot of the lower cost apartments and leaving a little room for the local tenants to be able to find dwellings where they can move into that are either renovated or better located. So that's creating pressure on the prices, and rents are going up. And in a market where rents go up, well, there's always possibility of value adding and adding buildings into the portfolio for the long term. So it'll be a pleasure for me to see you next month. Follow me. If you're going to Toronto this September, I'm going to be on the main panels in the morning representing the province of Quebec for multifamily and exposing sales and trends on the market. So you could always go check out CAIC 2023 off internet, and you will see that we're going to be presenting all the statistics that took place in the last year. And also, I've been speaking to my Canadian colleagues, docked in BC and docked in Toronto, and I could tell you that the Montreal market is the market that is most resilient right now and that has the highest performance in Canada as far as I can understand right now. So take great care, and we'll see you next month.